What is STL? STL is a generalization of what is commonly known as leverage. If we think about leverage, we can make a $3 equity investment and we can borrow $97 so that we have a total of $100. We can then invest the $100 in assets. And we can take the 100 divided by 3 and we can see that our equity investment is 33 times levered. What does that number mean? Mathematically, it means that if I have a 1% loss in my asset portfolio, that creates a 33% loss in my equity investment. So the question then becomes, with a mezzanine investment, what's the leverage of that? And today there's no really accepted term for leverage for that instrument. What I argue is that this concept of a sensitivity to a loss in the asset portfolio, we should add a few words, and that's what I do with STL. I say it is the sensitivity to a loss in your asset portfolio at the point your investment starts losing money. So see-through leverage for a 3 to 6% mezzanine slice is calculated very simply. What is the STL of the 3 to 6% mezzanine slice? The way we measure STL is we assume that you wipe out the value of the equity. And when we do that, you see that you have $3 worth of equity, you have $94 worth of debt. And so you have total capital of $97. We take the $97, we divide it by 3, and we see that you're 32 times levered. So that mezzanine slice itself is 32 times levered investment. The question then becomes, what happens if I resecuritize that asset-backed security with a CDO? And let's assume that I have the same capital structure. When I look at the CDO, again, I'm going to have $3 worth of equity, $3 worth of mezz, and then $94 worth of debt. The mezzanine, again, at that level, is going to have a leverage of 97 divided by 3, or 32 times leverage. If I want to look through and I want to see, well, how sensitive is that investment, not just to the underlying investments, but the underlying assets that were purchased by the asset-backed security, when I take that derivative, I have to multiply. So I get an STL of my mezzanine investment, my 3 to 6% tranche of the CDO, to be not just 32, but 32 times 32, or over 900 times leveraged. 900 times levered means that if you have a 1 basis point loss at the point where you start losing money, your investment loses 9%. So a very small error in your predicted losses creates a very, very large error in your investment. You can see how then suddenly, if there's a small extra loss that people weren't expecting, the whole structure collapses. I think if you look at the risk structures that were created, it was. I think if you look at what happened in the 1920s with the investment trusts, there was a massive increase in leverage that went unmeasured with the investment trusts. As you increase leverage, you massively increase the fragility of the system. The increase in leverage causes a massive increase in demand for assets, and so the asset prices rise, and it helped to create the huge run-up in equity prices in the 1920s. Those prices then were unsustainable and they were financed with an incredibly fragile structure. So as soon as the prices began to fall, they had to collapse. Similarly, in 2007-2009 crisis, basically from 2003 until 2007, there was a massive increase in leverage. That massive increase in leverage facilitated a huge increase in housing finance, and it facilitated a huge increase in leveraged loans. That financing began financing structures that were completely unsustainable, and they were financed via an extremely fragile structure. And so inevitably, if you allow leverage to go unmeasured, unmonitored, and unregulated, you will have a collapse. I'm absolutely hopeful for the future of finance. I mean, I think in order to restore confidence, you need to understand what happened. You need to understand the fundamental conceptual flaws. And if you can address them, and if everyone then understands them, and if everyone believes that we will no longer create those kinds of problems again, then confidence will return to the system and finance can return to normal. It's incredibly important to restore confidence. Right now, there is no confidence in the bankers. There is no confidence in the ratings agencies. And, the governments are financing the banks. The governments are helping to finance the insurance companies. And you need to have people to be confident in banks. You need people to be able to have confidence to take risk again in order to facilitate the economy.